Shopify is one of my favorite companies. It's been a big winning investment for me, and I followed the company for a long time. I had been putting off looking at the earnings report till I got a message from one of our YouTube followers. I decided it was time to take a look. And I will tell you what I see in the company's results and how the market reacted. I see a lot of different than the market's negativity. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you really should check out our special link. It's fool.com/unscripted. The Motley Fool is going to give you their best ideas right now. Check out that link. You'll be glad you did. Okay, so here's Shopify stock the day earnings came out. And like I said, woof, right? Down almost 13%. Now, this isn't a great day for the market. The S&P 500 was down about 1.4%. The NASDAQ was down a ton. So there is some context there right off the bat. It was a bad day for stocks in general, tech stocks especially, but definitely a bad day for Shopify. So what happened? I'll break it down for you. I'm going to take a look at the earnings presentation. We'll go through some of the key slides. I really want to focus on the bigger picture, the longer term, how much Shopify has evolved over the past just really 5 years, how far it's come. And then we'll talk a little bit about the company's guidance looking forward, how that played some role with the stock selling off. And then we'll end with whether or not I think Shopify stock is a buy right now. Let's go to the presentation. We'll go through that first. So we'll start right here. Revenue for the full year was up 26%. 28% more gross profit dollars. So you're seeing some leverage in the business paying off, and over $900 million in free cash flow. 2023 was a great year. And if we look at Shopify stock from the beginning of 2023 all the way through February 16th, stock more than doubled last year. Even as the market has continued to run, the stock has done even better than a really great market over that period of time. Great year. Let's start breaking down some of the key details in the quarter, how the company ended the year. So we're going to hit the high notes and we'll get into the details a little bit as well here, but gross merchandise volume, this is the total number of dollars that were transacted across Shopify's platforms by its merchants, not just the revenue that Shopify gets. $75.1 billion in the fourth quarter, 23% higher. Couple of good things happened. One thing that they called out, you see right there at the top, was that their existing customers, the same store sales growth of existing merchants was a big contributing factor. Also, just growth. Its merchant base is growing, not just in North America, but also internationally. They specifically called out EMEA, which is Europe, the Middle East, and Africa, seeing new acquisition and strong comps growth. And a big part of it too is looking beyond their SMB focus, their small and medium-sized business focus, and how much they're growing with enterprise, with large brands that are beginning to use the Shopify platform. We go from GMV to the revenue that Shopify earned. Again, GMV was up 23%. Revenue for Shopify was up 24%. So what does that mean? Their customers are doing more and more things with them. They break the business down into two buckets. Merchant solutions, which is largely tied to that GMV number, largely, not entirely, but generally it's going to track it up and down. It's a revenue share. And then subscription solutions, you see that was up 31%. This is a more steady recurring revenue part of the business, whereas merchant solutions can be cyclical based on what's going on with total merchant GMV. Now, a couple of caveats here. You have to remember, after about a year-long experiment with being in the logistics business, Shopify sold off their logistics business. They haven't fully lapped that period yet. So you back that out, and Shopify's revenue was up 30% in the fourth quarter. So really strong overall result. Remember that total, $75 billion in GMV. $45.1 billion of that was processed on Shopify payments. So this is another example of Shopify's evolution from just being an e-commerce platform where you could go quickly build an e-commerce website, have some tools, to being more full function. And now Shopify payments is increasingly becoming something their merchants use. 56% penetration a year ago, 60% penetration, more and more of that they're carrying on their payments platform. Recurring revenue is super important. On a monthly basis, $149 million in recurring revenue. Again, that's the majority of the subscription services are recurring. More of their merchants are on the Shopify Plus platform, paying a higher premium, more integration, using more and more of Shopify's tools. Shopify is definitely benefiting from growth and gaining operating leverage, but also some of their efficiency moves. 49.5% gross margin, up from 46% year over year. Subscription solutions gross margin continues to improve. This is that SaaS model, cloud-based software as a service, where as it gets larger, the incremental margins get even better. They're seeing the same thing in merchant solutions too. It's a matter of scale. It's really delivering for Shopify. I'm going to foreshadow a little bit. This also ties a little bit to the negative reaction we saw from the market that has sent shares lower since Shopify reported earnings. Operating expenses were down 22% versus the fourth quarter year over year. Now, a couple things. They lapped a big impairment charge related to real estate from the prior year and the sale of that logistics business, but lower headcount was certainly a big part of this. After they aggressively grew their headcount during and directly after the pandemic, management realized they had overexpanded and pulled back, made some tough decisions, but it looks like they're the right decisions in the business so far. Again, we're lapping a pretty ugly fourth quarter year over year where they had an almost $200 million operating loss a year ago, almost a $300 million operating income this year. Big improvement from a loss to a gain, but also a really solid overall number. Generating positive operating income means you're living within your own financial means. Free cash flow, want to hit on this because, again, talking about being able to live within your means. $446 million in free cash flow, massive increase because of the change in the business model, moving away from the logistics business, which is a low margin, high capital, high OpEx business, to the asset light focus on their services business. That's the core. Smart move, definitely paying off on the cash flow side. We're going to talk about Outlook briefly because this definitely played a role in sending the stock lower. We saw the quarterly results, revenue growth in the low 20s, and they're saying adjust out the impact of the logistics business as they still haven't fully lapped it. That's 500 to 600 basis points of impact from that sale. They're saying mid to high 20s growth adjusted for that. So not terrible, roughly in line with, I think, what the market was probably expecting there. But this is something that right here, operating expenses, I think is one of the things that kind of rattled the market a little bit and sent shares lower. They're expecting that operating expenses are going to increase in the low teens. That's right, coming out of a quarter where we saw a big double-digit decrease in OpEx, and now you're saying OpEx is going to go up? What are you talking about here? They're doing the right thing. They're focusing on the long-term needs of the business. But I think that's only part of the reason the stock has come down. We've talked about it before. What a run. The stock's up over 130% since the beginning of 2023. It's been a huge winner for a lot of investors. And there's probably a little bit of quote unquote sell the news going on where investors are just frankly taking some of their gains and being happy with it and looking at this year as one that might not be so great of a recovery turning full circle. But I will say this, if you think about how much Shopify has evolved, the core of what they're doing, so many of the things that they highlighted in that presentation, there's a really good reason to be maybe like me and hold your shares. Maybe even think about buying, even at this price. This is not a cheap stock, buying based on their ability to execute. If you think about all of the different things that Shopify does for merchants today that it didn't do even 5 years ago, this is a story of expansion of its business, growing its merchants, becoming more fully integrated with the way that its merchants do business and becoming more important to them, becoming more sticky, increasing the services you provide to them. Let's focus in on this right here for just a second. Again, we just talked about a 2023 fourth quarter where operating expenses came down by double-digit rates. And now you're saying operating expenses are going to increase a low teens percentage. A couple of caveats on that I think are important. So they're still saying they're going to grow revenue low 20s and adjusting for the logistics business, the core remaining business is going to grow mid to high 20s. They're saying, yeah, you know what, we're growing our expenses, but we're growing our expenses at a lower rate than we're going to grow our revenues. That's still operating leverage. At the same time, you look right here to the left, still expecting gross margins to increase. So increasing your gross margins, growing revenues faster than you're growing your operating expenses. So you should be growing your operating margins as well. Those things should compound and help deliver better results on the bottom line as well. I'm expecting better free cash flow, better operating cash flow, better net income in 2024 than we saw in 2023. So sure, the stock is down since earnings came out. Does that mean the stock is cheap? No, it's not cheap. Even with the big improvements in the operating results, the better results on the bottom line, this is certainly still a story of multiple expansion. This is a stock that was trading for about 8 times sales at the beginning of 2023, trades for about 15 times trailing sales now, closer to 12 to 13 times expected 2024 revenues. So it's not a cheap stock. And if we look at it based on price to free cash flow, definitely not a cheap stock. But you're not buying it because it's cheap. That is to say, you shouldn't be buying it because you think that it's cheap. Buying Shopify today is a buy based on the signal that the business is executing. It's getting great operating leverage. It's still growing at a very fast rate. And there is still a very large and expanding addressable market that Shopify can continue to take a larger and larger piece of the pie from. And over time, it should be able to grow into that valuation, generate wonderful cash flows, and investors can continue to earn market-beating results for that performance.